Equity markets were lower across the board on Friday, and a lot lower as coronavirus fears spread through the markets again. We saw 10-year note yields go below 1.5%. We saw gold spike higher, and equities were catching all the heat as sellers came in and drove E-minis way down off the highs. And if you go back to October. Since October, coming into this week, we'd had 15 out of 19 up weeks. And so today makes it 15 out of 20. But I think at this point right now, the bull market in equities really hasn't been affected despite the pullback we saw today or the pullbacks we saw over the last couple of weeks when the coronavirus was running rampant. I think there are just going to be moments where we have to get our sea legs back under us. Equities remain the place for returns. Obviously, with 10-year note yields trading south of 1.5%, there's not a whole lot of meat left on that bone there. So you're going to continue to see the money go into equities, maybe a little more patiently as E-minis have recently hit all-time highs. Do you see a pullback? Maybe they won't be so quick to jump back in with both feet. But at this point, equities do remain still a buy, despite the fact that we saw a sell-off this week. The VIX index, another good indicator. It's always been a looking back indicator, but I think one of the things we have to notice is that throughout this whole coronavirus, going back to the end of January through today, we haven't seen the VIX index get above 20. Now, last summer, when we were talking about the China-U.S. trade deal and the risks that were carried with tariffs and whatnot, we saw the VIX get over 20 several times. And so you're looking at how the market is reacting. There isn't that panic. We're not redlining. And so implied volatility over in the equity markets isn't suggesting any real fear despite these 30 handle down days in the E-mini S&Ps. So the volatility index measure hasn't exceeded levels that we saw last summer when I think the risks are probably a little bit greater here. Maybe if you look at the trade risks versus the unknown risks, what we know is maybe more fearful than what we don't. But at this point, the coronavirus has not given the market that scare. I think that trade did, and it's interesting to watch. So we are up in the VIX index today in the 17 handle, but we haven't seen the 20 trade since this came about. Lastly, next week, we have a lot of data coming out next week. Month-end stuff, we'll get Chicago PMI, we'll get some PCE data. But I think ultimately everybody's going to be waiting for that next headline, whether it be positive or negative. And I think the canary in the coal mine here is twofold. I think you watch gold prices. I think gold prices will be a good indicator because while central banks have been very dovish and will remain to be so, I think that gold prices going higher now is more than just a central banking issue. And secondly, it's going to be oil. Oil prices going down suggests that there's a risk to global growth. And I think at this point, if we get back towards that 50 handle in oil, that's also suggestive, and that could be very negative to equities. So at this point, the bull run is not over yet, but we have a bit of a stall today. Heading into the weekend, stocks across the board much lower, and next week we'll be continuing to watch the headline risks, which dominated this week.